Hello, everyone. This is Jay Wicker with Small Business Stand Up. And as usual, we got some phenomenal entrepreneurs on the call with us today. So, you guys, tell us a little bit about what you guys do, where you're logging in from, and all that other good stuff. You start at the very top left. Mr. Kenan?
Yes, sir. Hey, everyone. My name is Kenan Godfrey, and I am based out of Macon, Georgia. And I am a How Money Works financial educator, and I'm happy to share with you today's class on some basic principles and things you need to know about how money works.
Excellent. Excellent. Tony, you want to jump in?
Yes, my name is Tony Opey. I'm located here in San Jose, California, Silicon Valley. And as well, I am in the financial education field, helping people, teaching them about how they can set themselves up for a great financial future.
All right. Hey, how you doing, Mr. Lamy?
I'm great. How are you doing? Hello,
I'm great.
everyone.
Hey, you right on time. Tell us a little bit about what do you do, where you're logging in from, all that good stuff.
Hello. My name is Alami Dixon. I am logging in from Southern California. I am the CEO and business strategist from Credit 909. What we do is we help entrepreneurs and small businesses establish their business, fully structure their business, and put them in a position so that they can qualify for funding. And we also help them establish their initial trade lines that will be reporting to their Dun & Bradstreet. So our services is full service, help them from the infancy stages, EIN, fictitious business name, all the way up to their first net 30 trade lines on their credit or their business portfolios.
Excellent. Ms. Danielle, is on you.
All right, I'm Danielle Macarthur of Dcdr Solutions. I'm a entrepreneurship small business coach. I utilize continuous improvement techniques to help build the structural foundations of a business and then teach people root cause tactics to help remove the obstacles that they may incur as they grow towards their greatest dreams.
Excellent. Ms. Kizzy is on you.
Hi, I'm Kizzy. I'm an accountant, entrepreneur as well. At Fast Tax Central, my company, we take care of individual taxes, business taxes, bookkeeping, and also business funding and mobile notary.
Excellent.
And we're located here in Montgomery, Alabama.
Okay, wonderful. Ms. Sheila is on you.
Hi, I am Sheila Little, the CEO of Shaping Solutions, and I do coaching and some consulting and just help people transform their life from the inside out.
Wonderful. We appreciate you guys jumping in as usual, man. I think today is going to be a different type of show today. So we got Kenan here, man. Godfrey's going to go over some good stuff, man, about how money works. So, of course, we're entrepreneurs, so we want to know the other side of this thing. So when we make money, how do we save money? How do we continue to have money work for us? Stuff like that, right? So if you guys, as we go over this presentation, if you can write down a couple of questions, we may want to ask him afterwards, man. I'm pretty sure he'll stay until all of your questions are answered. So, all right. Mr. Kenan, you about ready?
I'm ready. Yes, sir. Absolutely.
Let's rock.
All right.
Did I do the right one? Okay.
You got me in the middle here.
I got the wrong one.
The slide.
Perfect. Okay. Give me 1 second. There we go. We go.
Yes, sir. All right. Well, welcome everyone, and I hope everyone had a great day, productive day, being entrepreneurs and aspiring to entrepreneurship. Today, I have a class that's called How Money Works. This is the Enterprise Edition. This is done, one of our versions. We have different versions of this that we teach. This is for businesses and organizations. And again, my name is Kenan Godfrey, and I'm going to be your financial educator for the next hour. Now, one of the things I'm going to go ahead and drop off for you guys right at the beginning here, just to kind of help you make me maybe pay a little bit more attention, is I want you to look up the word, go to Wikipedia and look up family office. And family office, if you don't know what it is, I'll tell you, is essentially a business that ultra high net worth people set up to manage their wealth. The first thing and the primary thing, the reason they do it is because usually they've had a liquidity event where they had maybe $100 million or so. And so they want to make sure they don't ruin that or blow it. And so they go and get the education and they set up a business that's basically set aside to manage their wealth. So they start out with education. And so everyone really, most likely you're making more money and you have more than you did 20 years ago or 10 years ago. So you should really treat your money the same way that rich people do. And a lot of what we teach is about, shifting into that mindset of the wealthy, and and some of that stuff you'll see throughout this presentation. So I'm going to start off the presentation here with and feel free to, if you have questions, write them down or put them in the chat. I'll be looking at that. Or if you want to interrupt, that's fine. But this should take maybe, I'll try to keep it around 45 minutes or so we can get you through it all. But we're going to start out here with this quick video showing our book, which is a resource that we share with everyone. You are welcome to a copy, and I'll show you how to get it at the end of the presentation.
More than 5 billion people around the world continue to struggle with money.
I just want to make sure you can hear that. Can you hear that, Jay?
Yes, I can hear it.
Okay, great.
Yep.
And financial illiteracy.
It's Madison Avenue manipulation, right? It's been going on for years and we buy into it.
How bad is financial illiteracy?
It's not taught in school, so people don't know this naturally.
You're right.
So you grow up not knowing anything about it. You make a lot of mistakes along the way, and we're hoping to educate them and teach them how money really works so they can learn the cause and effect of all this.
And it doesn't have to be generational.
Exactly.
No.
Exactly right.
Break that cycle.
Once you understand the basics of financial literacy, it changes your life. The secret is financial literacy. I mean, teaching your kids how money works. I think it's really understanding how money works. Once they understand the basics of how money works, they shouldn't have to struggle for very long.
Steve Siebold and Tom Matthews are the authors of How Money Works. Stop being a sucker.
Money means possibility. It means opportunity. It means freedom. Things you've always wanted to do, dreams that you have. Money makes it possible.
Of all the interviews we've had in the last 6 weeks, I'm actually most encouraged by that one.
So we're really proud of the book and how it's been, featured, and now by this point over 200 major TV shows. You may have heard of it even because 100 million people have seen the book somewhere in America through these various media outlets and appearances, which include the likes of Fox, Today, CBS, CNBC. I mean, it's just an amazing book because it really breaks it down and makes it simple for people to understand these critical concepts. So it's not a snooze fest, and we're not trying to give you a PhD in finance, but a lot of times people skip the basics, honestly, and they go right into the deep end, and they don't do so well because they don't have the foundational stuff right. So everybody needs this, in my opinion, and I think it should be in every home. But I think the reason that the book has been a great success is because the book is fun and approachable. These are some of the illustrated characters that, ask questions and that are demonstrating, real life scenarios. And, it's great. Kids love it. Adults love it. It just has such a wide appeal. Everybody's got a favorite personality. that you could probably identify with one of these characters. And mine, it varies. Sometimes it's Hector, and sometimes it's Clark. I like both of those guys. They tend to be very interesting. So, like I said in the beginning, the first decision you really got to make is simple. Well, are you going to choose the mindset of a sucker? And we use that word a lot. We use it lovingly, and I'll tell you why in a minute. But are you going to think like a sucker, or are you going to think like the wealthy? It is a choice. And the fact that you're in this class today is a sign that you're on the right track. Here's the great news: you don't have to be wealthy to think like the wealthy. You only need action and knowledge in order to apply that. So this is your best opportunity to gain the knowledge that you need that's going to prepare you to take action. Now, we know the word sucker sounds insulting, like I said, but this is the best way to describe someone who can be taken advantage of because they don't know how things work. Not knowing how money works does actually suck. It sucks up your time, it sucks up your freedom, and it can suck up your income, and that sucks. So, this class is going to be split into basically two different parts. The first, we're going to cover these 5 concepts, these principles that we feel that should be taught in school but aren't. And each is essential to the foundation that's required to start making financial decisions with confidence and start taking action to get yourself on track. And now the second half of the class is actually going to be more applied knowledge. How do you put these principles into action? And some examples, some real life strategies, things you can take away from it. So, let's talk about the financial illiteracy crisis. Now, I bet you wouldn't believe this, but it's a crisis that affects over 5 billion people in the world because they're considered financially illiterate. And it's also the number one economic crisis in the world because of that. It's bigger than the recession, bigger than unemployment. I mean, it's just huge because it's costing people money on an annual basis because they don't know how money works. Now, if this were 1920, there would be, there'd still be, a really large chunk of the population that couldn't read. They were actually just illiterate. They weren't financially illiterate. Now imagine what life would be like today if you couldn't read a prescription bottle or a bus schedule or your kid's report card. Public education changed that over the last 100 years. And today is really almost unthinkable that someone can't read. But somehow it's still okay for most of the population to be financially illiterate. And we're here to change that. We wrote the book and are doing the classes that are based on the book, so that financial illiteracy becomes unthinkable just as being unable to read is unthinkable today. Now, over 5 billion people in the world are considered financially illiterate, like I said before. And that references a study that was done around the whole world. And they found that only 30% of the people in the world are considered financially illiterate. And the study used a simple money quiz to reveal that the vast majority of countries all over the world, they're unable to answer those few basic questions. And now this class is really going to get you the answer to those questions, so that, and many more. And it's the reason that I teach this course. Just look at some of these numbers on the screen that you see here. 44% of Americans can't cover a $400 emergency or make their student loan payments, or consider paying off their credit card debt, or even consider retiring. 33% they have zero in retirement savings. And, and this number, with the COVID and the recession looming, it's likely to get a lot worse. But with knowledge and action, we can maybe change some of these numbers. Now, why is that so? And how did that happen? One of the reasons why is because they don't teach it in school. Only 21 out of 50 states require at least one class in personal finance And it talks about, usually that class talks about balancing a checkbook, which is so basic that people don't even balance check. They don't even carry checks anymore. But think about this: how many of the schools are teaching some other, extracurricular, quote in air quotes, class like sex ed, or they're teaching broadcast journalism or something like that, and most of them have that, but they don't have this in their curriculum. So you can't make this stuff up. It just doesn't make any sense to us either. So let's get into the first principle here and concept we're going to talk about, which is the power of compound interest. And the power of compound interest, it really refers to the growth potential of money over time by leveraging the magic of compounding, which is the interest paid on top of the sum of the deposits plus all the interest previously paid. So Zoe puts it real simply. She's one of the characters. She says it's like interest on interest. This is what Albert Einstein had to say about compound interest. He said it's the greatest mathematical discovery of all time. And let's take and this is the guy that came up with E equals MC squared. So, for him to say that about this means you should really pay attention to this. Now, here's how saving monthly with compound interest can be a game changer. The interest ends up being way more than the amount that was saved. Just look at this graph here for a second, and I'm going to explain it. They're putting in $500 a month into an account that's earning 9% average interest rate. In 45 years, they would have put in $270,000 into the account, but they've got $3.7 million in an account somewhere. That's all compound. That's the power of compound interest. This is why the rich get richer and richer. Now, here's an easy question. Does your rate of return matter? And the answer, of course, is yes. It matters a lot. So check out this example on different interest rates. And the only thing that's changed is the interest rate, okay? So this could mean as much as almost 800% more money at 9% versus 1%. That's almost $900,000. This is an account taking $178, putting it somewhere at these various interest rates. I mean, that's just mind-blowing. I've been teaching this since 2003, and it still blows me away that really having a better interest rate makes that big of a difference. And this is why Albert Einstein said that this was the most powerful force that he had discovered. Now, we've all been guilty of squandering time, especially, it just costs a lot, when you lose the value of money over time. You never get the time back, or you don't get the money lost either. And there are 3 action steps that you can use to leverage this principle, which is the time value of money. Number 1, start now. Number 2, save regularly. And 3, be patient. That third one kills a lot of us. Starting earlier is always a good idea. Take the example where Sarah starts saving at age 22 and saves for 8 years. So she puts aside $4,000 a year or $333 a month for 8 years. She stops at age 29. And so she's put it in. She's only added $32,000 to this account. And now look at George, who starts saving at age 30. He sets aside the exact same amount on an annual and monthly basis, but he goes all the way to age 67. And Sarah still has more money. Almost 4 times less that she put into it. He actually added in $151,000 just to get to, in the ballpark of where she is. So again, this is why the rich get richer and how it's, almost nearly impossible to catch them, because if you're starting off with more money and time goes by, you're going to have more. So it's just the way it is. Now, here's a picture of numbers that break down. If you ever thought about, I want to be a millionaire, everybody thinks that's a big number, and it is. It's a milestone. So if you want to have $1 million, here's how much you exactly need to save in an account earning a 9% interest rate at different ages. And this really nails home the time value of money. So for each million that you want to have at age 67, just look at your age on the chart. If you're 20, you need to set aside $113 a month at a 9% compounded annual interest rate, compounded monthly. You'll have $1 million at retirement. That sounds very doable. But what if you're later down the road, 45? Well, you got to set aside $1,200 a month. 55, $3,880. 60, it becomes almost undoable. At $8,500 a month, just to put aside enough. I mean, think about it. You only have 7 years to get to the million that you want. So, at that point, you have either two options. If you can't make it to your goal, shrink your dreams or find a way to earn some more money. Which is why I love this group here, which is focused on helping people to become entrepreneurs and teaching people about business as well. And that's very important, especially with people not being on track for retirement and so forth. But let's take a look at something that a lot of parents dream about. And we're going to show you how to tie in two of these concepts, time value of money and compound interest. But specifically for a newborn child or a young child that someone has, parents have been often thought about, they want to create some generational wealth. They want to leave a legacy for their children. Well, this is a new twist on this approach to leaving an inheritance for the child. And we call it the $1 million baby. And one of the things that this really addresses is that, first of all, only 20% of children are going to get an inheritance. That's a study. Not many people do get one. But we can show a common sense strategy that reimagines the way that people will help their children plan for a secure retirement. Now, let me ask you this. Which legacy plan is more realistic for you? If you want to have your child $1 million at retirement, what's more likely? You give them $1 million in cash when you're adults and you've saved enough, or you develop a plan to save a fraction of that amount for each child when they're young. So everybody's thought about buying a car. Everybody buys cars. So this is a very good example on how to really think about this. Okay, is it unreasonable for someone to put down $2,500 for a used car and agree to a $250 monthly payment for 4 years for the used car? Now, what's more important, a used car or your child's future? So let's show you how to do this. If you can afford a used car, you can develop a plan for your kids to have $1 million waiting for them in retirement. So in this example, Hector puts down $2,500 and $250 a month was added for 4 years to an account. And so at age 67, the son has $1 million waiting for him at retirement. Now, it's all because Hector learned about these principles, time value of money, compound interest, and that's what allows him to do that. So this is a way that just about anybody can, if they want to really seriously leave an inheritance for their kid, they'll probably need more than $1 million at retirement just because of inflation and all of that, but they'll have something that mom and dad set aside for them. Now, this is my favorite concept, guys. It's the rule of 72. You guys ready to learn this one? How many of you have heard of that before? I know Jay had mentioned it in the
yes.
email. Okay,
definitely heard of it.
Yeah. Yes, sir. It's a middleman shortcut that the wealthy have been using for years, and everyone should know it. You simply divide the interest rate into the number 72, and it tells you how long it takes for your money to double. It works for you if you save money. It works against you if you borrow money. So at 1%, it takes 72 years for $1 to turn into $2. That's a long time. Now, why would anyone knowingly choose that on purpose? They're going to put their money somewhere where it doubles every 72 years. We're going to come back to that question. Keep that in mind. So, as you can see on this graph here, the better return you get, the faster your money can double. At 3%, you get a double every 24 years. At 6%, 12 years. And then 9%, 8 years. And then 12% every 6 years to a double. That's what we're talking about. We need to double much faster if we're talking about building wealth for retirement, financial independence, whatever you want to call it. Here's another way to look at it. In terms of the number of doubles you could have over your lifetime, at 1%, you'll be lucky if you live long enough to get one double. Look at Zoe. She gets this inheritance of $10,000. And if she put it somewhere like, that gets her 1%, she's barely got one double, in that 72 years. At age 67, not even a double. Now, what if she got 6%? She could get 4 doubles and have 10 times the money. Isn't that amazing? You would think it would only be 4 times the money. It's 10 times the money, $160,000. Now, what would you get if you did, 9%, or 12% even? $2.5 million, just because you made a smarter money decision, and that's it. That's the power of compound interest. So remember when we talked about that 1%? Would anyone choose 72 years for the money to double? And yeah, the fact is that is absolutely true, because there's $10 trillion in money market and passbook savings accounts that are earning 0.09% interest. That's the national savings average that they return on those. Not even 1%, 0.09. And so when CNBC did a review of our book months ago, this was one of the things they pointed out to be almost unbelievable. And guess how long it takes for your money to double at 0.09? 800 years. So by the time 2822, your dollar turns into $2. So your great grandchildren are going to be super thrilled that as Clark is saying here, they're going to be just thrilled about that whole thing. So anyway, now here's the other flip side to it. The same place that's going to give you 0.09% is going to charge you 17% or more for a credit card. That means their money doubles every 4 years. And so now you can see why our book title is called Stop Being a Sucker. You need to know how money works today, not tomorrow, today. So you can use this to figure out all kinds of things you need for whether it be a savings goal or what a loan will actually end up costing you. It's a great tool to have in your mental Rolodex and mental toolbox there for you to be able to use in your life. Now, of course, this is the other reason they call it Stop Being a Sucker. The banks give you a lollipop for the trouble of waiting in their line. You get to the end of it, the counter, and then they say, they give you a lollipop. And what kind is it usually? It's a dum-dum, right? Most of the time, it's just like, it's like they're trying to tell you, but you just don't have the code. And, it's like, it's crazy because they know you stick your money there, it's going to take you 800 years for your money to double. Where the bank's money's doubling every 4 years or so with just credit cards. They do other things too. I mean, it's amazing what banks can do. And, just as an aside point, you can actually use, strategies that we talk about with these principles with compound interest to set up your own sources of financing so you won't even need banks. And it's a lot of stuff you can do once you get these basics down, and understanding these basics is fundamental so that, more advanced strategies that build on it, you can understand them much better and appreciate them. So now that we covered those concepts, we're going to get into the 7 money milestones. And these are going to be ways that you can just put what you just learned, some of that information, to work right away. So the first milestone, and let's just go through all of them. Each of these milestones that you see on the screen are going to help you reach your financial summit, which is ultimately financial security and independence. And because we're spending this time together, your education is growing concept by concept. You're going to get strategy by strategy to help you really gain more control over your personal finances. And what we do is we recommend you sit down with a financial professional or a person you trust. If you don't have one, we could definitely connect you with somebody that can help you with these things. We don't recommend you go it alone because the terrain is unfamiliar, and there are things that you just simply will not know about because you're not involved in the industry. So get the first step, this one, the financial education, become financially literate, and then find a financial professional. And as a financial professional myself, I'm here to answer questions. I have a newsletter. If you like this kind of stuff, you definitely want to sign up for the newsletter. I give little tidbits every 2 weeks. I don't mail a lot, and just kind of keep you along those financial educational needs. And then if you need to sit down with someone, sit down with me. We can definitely do that as well. Now, in the war for your money, here's the thing: there's 2 essential tools you need to win. And the best starting point that we know, and just from studying the rich. Remember how I said that, you just had a liquidity event, $100 million. What are you going to do first? Well, you'd be a fool if you don't start out with education. And so education is where we start all of our clients. And you need to take it seriously. You didn't get it in school, didn't come from your parents. This isn't just stuff you just pick up. Treat your finances with the level of dedication that you put into your health. Google things, ask questions, and be curious. Be a lifelong learner, but then turn to a financial professional who speaks the language to help you navigate the financial services industry and make the best choices for your family. Now, this is a time, where you can put everything that you've learned into action with your financial professional. They can assist you to crunch the numbers, chart your path, choose the right products, stay accountable, and course correct along the way. Again, just want to reiterate, don't try it alone. Even Elon Musk, every family office has a financial professional in it. Google Elon Musk family office when you get a chance. You'll see his number one guy. Everybody's got a guy. You got a business, you need to have a family office or somebody that can get you this stuff. This is what I do. This is all I do. And it's it's more than a notion to stay up on all the changes that are going on. And so you do want someone, and you want someone like and trust, and make sure that person's doing a good job for you. If you've already got one, that's great. Keep doing that. We recommend that the relationship is the biggest thing, and we also like to know, like, and trust who we work with, because it makes the experience more pleasurable when there's a mutual beneficial relationship happening. So don't pick someone that's good, but pick someone that you can relate to, that you can have a good relationship with. Because when we do these relationships, I've got 30-year relationships right now with clients, going back institutional clients going back to 2004 when I first got into the industry, individual clients that come out of those institutions and so forth. So it's a very important relationship. I don't take it lightly, and neither should you. Proper protection is milestone number 2. And this is important. Is number 2 for an important reason. Now, you need to protect yourself and your income. Protect your family, from the loss of the income that you may generate, your business may generate, or savings before you really generate go along the rest of the journey. I mean, if you were to die prematurely, your family could be left without you and your income, in addition to being without you. Your current savings just may not be enough to take care of them. You need to plan. You need a plan that really self-completes, even if you aren't around to complete it. So only 59% of Americans have life insurance, and about half of those are underinsured. And when it comes to life insurance, there's two major questions that we get asked all the time. How much do you need? Together, you can consider factors like how old you are, how much debt you have, your health, your number of dependents, your role in your business, and your overall financial situation. You really want to get with a financial professional to get a specific calculation of your family's need. Now, the first question is, how much life insurance should I have? Well, that's an answer. It's different for everyone, and it's based on your situation. However, as a rule of thumb, we recommend you consider having life insurance coverage that's at least 10 times your annual family income. But keep in mind, that's only a starting point. The next question is, what kind of life insurance should you get? Just like with so many things, life insurance, with all the options out there, seems very complex at first. But once you know a little, it becomes far simpler. And to start, it's important to understand that all life insurance usually falls into two basic categories. There's temporary and permanent. And all you guys in real estate know the difference between renting and owning. That's basically what it is. Temporary and permanent. Temporary, you rent. Permanent, you own. Okay? Real basic. Now, take a look at this X-Wave here. This is a very important graph. It really kind of drills down, where those two types of insurance are really optimized. Now, in the blue on the left, you see, a new family. We're starting out in life. That means you have, maybe you're raising a family. You just got a house. You're paying for college, or you still got student loans or whatever. So you have less wealth. So term is going to be more. Temporary insurance or term insurance is typically the most useful then, because you don't have a lot of money, but you need a lot of protection. And if, as later in life, usually the older you get, the more wealth you tend to have. If that happens, then permanent insurance is going to be a viable and profitable version of the insurance protection that you may want to have. And again, your financial professional is someone who can help you look at this X-Wave and see how it can be applied to your situation. Now, temporary and permanent insurance are the two basic categories. So let's look at that first category, temporary or term life insurance. It's called term because it simply lasts for a specific term of time, like 10, 20, or 30 years. So it has an end point, a beginning point, and an end point. And it's also the most affordable form of life insurance because it provides just one core feature, and that is a death benefit. That means the money gets paid to your beneficiary when the insured dies, and it expires after the term. So what happens after the term ends? Well, there's two possible scenarios that you can look at. Number one, you no longer need the term life insurance. And so that's real basic and simple. You just let the policy end. It's a done deal. Now, what if after the term you still need some coverage? Well, and there are reasons why that might be. You might still be paying off your home, or you just had a new oops baby, or whatever the case is. Maybe you went down to one income in the household, or supporting grown children, grandchildren, things like that, or still running your company. For these reasons, you might consider scenario two, which is keeping your term life insurance. Now, let's take a look at permanent life insurance on the flip side. Now, just like term, it provides a death benefit to protect your family financially. However, permanent life insurance is designed to be kept and to protect your family for your entire life, not just a period of time. And think of permanent life insurance as a lifelong strategy that can protect your family today, secure your wealth in the future, and provide for your family after you're gone. Long-term care insurance coverage helps cover out-of-pocket expenses that can really add up. And it can be used to pay for qualified services like nursing home care, home health care, assisted living care, or adult daycare. And take a look at these statistics on the screen. 70% of people age 65 or over will need some type of long-term care services and support in their remaining years. 8% of people age 55 or over have purchased any kind of long-term care. So, that it's the thing about long-term care. You don't know if you're going to need it or when you're going to need it. And, but it is something you need to be aware of and to potentially check that box off. Again, this is why we do this education. And, if you do need long-term care, here's what it can cost you. And, if it ends up being more than 1 year, the average is about 3.9 years. Take a look at some of these costs here for adult day healthcare, just under 20 grand a year. Assisted living, 48,000. Home health aid services, 50,000 a year. Nursing home, 89,000, with a semi-private room. If you want your own room in a nursing home, that's 100 grand a year. So the costs without the long-term care coverage could drain one or more of your savings assets that you were counting on in the future. That's the reason that you get this type of insurance, is if you have assets and you want to protect them. But you don't want to wait till too late. You can't just get it right before you get sick. You got to have it in place before then. So I just want to point that out. Now, there are different ways that you can get long-term care insurance, and the traditional is a standalone policy. Even if you don't have any life insurance, you can go directly to an insurance company and purchase a standalone long-term care policy. Or if you have a permanent life insurance policy, you can opt to have it added on as a rider to your policy. It may be able to be added on at no cost or for a little extra cost. So everyone should look into that option, especially if you're looking at buying new insurance. Might as well get it with the long-term care if that's an option. Now let's talk about what the cash value component of the permanent insurance is, because permanent insurance builds cash value in it, and a portion of basically the way it works is a portion of your monthly premium set aside into an account that grows over the life of the policy. It does get interest, and you can start taking advantage of the compound interest and all that stuff. But the money in that account is your cash accumulation. It can be used for whatever you want. It can be used to fund future purchases like cars, vacations, weddings, whatever the case is. It's your money, so you can use it for whatever you want. The possibilities are really endless. And this is one of the ways where you can, where I mentioned earlier, you could be have a financing, self-financing. This is a perfect way. I show people how to finance their cars, finance houses. I have a lot of real estate investors who use this cash value benefit to do that, and they're building their wealth all along the way. And I'll show you on the next chart just a visual of that. But it's also, there's a lot of benefits: tax-free growth, creditor-free, zero market risk, tax-free income. A lot of great benefits, and tax-free the income at retirement is huge. A lot of people will do the life insurance as a tax-free income supplement. Now, other benefits that we're looking at, and this is the chart I was saying. So if you look at this green graph here, that's how money grows on the compound interest chart, right? So one of the things, if you're, and I don't want to go too far off because I'm not going to get into it right now, but basically, if you're building wealth in this and you're saving money, you can borrow money out and put it back in, and you'll be at this point on the chart. So in other words, a lot of people, we finance everything we buy. I don't know if you know that, but you do. You either save up the money in a bank and then you spend it, or you borrow money from the bank and then you pay it back. There's really no other two ways to get something and acquire something that way. So we finance everything we buy. So if you could build wealth and use some of it to finance purchases, why not do that? So that's what this kind of permanent life insurance can be used to do. That's a whole training in and of itself. So I'm going to end that on there. But the next milestone, and we got about 4 more to get through, so I'm going to kind of get through these, but so we won't take up too much time. So once you've got milestone number 2 covered, you want to have an emergency fund. Emergency fund is going to be 3 to 6 months of income that you would need for any expenses that may come up, and that's basically what it is. It's there for, you have a car repair, you have a home appliance that you got to repair, and unemployment, or even if you're an entrepreneur, a bad couple of months. Emergency fund's perfect for that. If you're currently living paycheck to paycheck, like many people are, your emergency fund could be that insulation that's going to separate you from financial disaster if something happens. Check out these incomes and how much you might want to have saved for our 3 to 6 month guideline there. Now, the thing about the emergency fund, there's 2 rules that you got to have. Rule number 1 is your emergency fund is only for unexpected emergencies. That is it. It's not for gifts or giveaways or that extra vacation money. Doesn't matter if it sits in your checking account, savings account, or a separate account, as long as you're not tempted to use it for anything but a real emergency. Rule number 2, if you need to use the emergency fund to fix a car, replace a fridge, pay for braces, take the money and spend it. That's what it's there for. Just don't even hesitate. That's why you put it there. And then just make sure that you add back a little to that fund every month until your emergency fund is full again. Now, TJ has a good question, which might get you thinking too. Where do you get the money to create an emergency fund? Well, the best tactic, especially if income is tight, is like just for most, is to put away a little each month until you reach your suggested goal of 3 to 6 months of income saved. Now, think of it as a debt payment to yourself due until you reach your emergency fund goal. Speaking of debt, once you've got all these other milestones, squared away, you got your proper protection, you got your emergency fund. Let's talk about managing debt next, which is our 4th milestone. Before you can fully enjoy financial security and independence, you'll need to look at your spending habits, strive to reduce, and eventually eliminate your debt. We hate to say this, but in our culture, debt is a sweeping crisis perpetuated by a society of suckers led astray by the instant gratification desires of our generation. And that's a mouthful, but it's true. There's no shame in admitting that you struggle with debt, as it's one of the most common threats to having a sound financial future. But it's something that we do have to face head on, and it's best faced head on with the support of a financial professional. Now, here's what the average American debt is struggling with: about 28 grand in personal debt. That's not including mortgages, and many have much more. And don't forget, over half of Americans suffer some kind of anxiety relating to debt. Now, when debt is removed, we can enjoy life more fully and more freely. Things now have been hard with all that's been going on right now. So here are 5 tips to eliminate and stay out of debt. Number 1, know what you owe. Number 2, no more late payments. Number 3, go after one debt at a time. 4, stop charging and cancel unused subscriptions. And 5, consider refinancing your mortgage. So let's dig into each one of these, starting with know what you owe. Now, you may have heard that by law, every American has a right to a free credit report every 12 months. Most people make the mistake of Googling annual credit report. And when they do that, they get tricked entering their credit card information into a free trial for a credit monitoring service. And of course, they forget to cancel the service after the free trial. And now they're going even further into debt when they're just trying to get out of debt in the first place. Just go directly to annualcreditreport.com to get yours. Check the websites of the top credit reporting agencies for pointers to improve your score and report any errors. And look for the word dispute. Number 5, increase cash flow. Increasing cash flow is milestone number 5. And while, suckers, they gripe about how tight things are, the wealthy are plotting how to free up more cash flow. This means seeking out ways to earn additional income and better managing their expenses. So let's look at some ways to do that. Tips to increase cash flow quickly. Create and stick to a budget. Develop a written game plan. Reduce spending on expenses like car and home insurance. Reposition your savings. If you have money sitting in a low interest savings accounts, move it to somewhere where you can get a higher interest rate. There are a lot of great options out there you may just not know about. That's why you got to have a financial professional. I mean, there's literally an option right now that I just share with some clients. You can get up to 15% interest on your IRA retirement money with zero market risk. Why not take a look at something like that if you got some safe money? Anyway, and then drop your private mortgage insurance if you qualify. All you got to have is about 20% of your home value, and you could probably get rid of that. But talk to your mortgage person about that in particular. Now we're finally at milestone number 6. That's this one is my favorite one. It's really the one I focused on when I came into the industry back in 2004. I was teaching people how to retire. I worked with a lot of public sector employees down in Florida, the Florida sheriffs, and down city employees in Jacksonville and so forth, helping them to build wealth for retirement. And that's how you get financially independent, is to build wealth. So this is where you got to look at avoiding taxes and losses and inflation. And you got to do your best to accumulate and grow your net worth. So there's 4 threats that everybody must conquer. If you're building wealth, think of these as your 4 wealth building enemies. Each will come at you from a different direction. And to beat them, you're going to have to address them individually. Let's start with one of the worst, which is procrastination. As the quote says, procrastination can be hands down our favorite form of self-sabotage. And then we're going to look at market losses, inflation, of course, taxes. But if you get the information, you don't do anything, there's no power in that knowledge. Knowledge is applied, it becomes powerful. Inflation is known as the tax of time. Everybody this year especially has really experienced it in the gas pump. The annual inflation rate has averaged right at about 2.8% for the last 100 years. And, can you approximate the number of years it takes for the cost of goods to double at a steady 2.8% annual inflation rate? This is the rule of 72, folks. Yeah, just take the number divided by 72, and it takes almost 26 years for things to double just at the baseline. And we saw much higher interest or inflation over the last year, and it probably may be this year as well. But the average has been about 26 years over the last 100 years. So this is one of the essential reasons to build your wealth using the power of compound interest to stay ahead of inflation. The other thing that this shows you is that if you're not getting 2.8% on your money, what does that mean? Oh, you just lost half of your money and it was sitting in the bank account, in the mattress, or wherever it was. So having money places and understanding these basic things, again, that's why I said a lot of people jump over the foundational stuff, but this stuff is so key. Now, when you know that this enemy is slowly devouring your savings by raising the cost of goods, it should really drive you to be even more committed to your growth building strategy. And don't let it scare you. Let it drive you to action, though. Now, let's talk about the impact of losses. This is something that can be a big enemy to wealth building, and it's often underestimated. It's a threat that can wreck your savings goals and force you to adjust your lifestyle and retirement. Here's a simple picture that illustrates how people miscalculate the impact of losses. If you were to lose 50% of your investment, which happened twice in the stock market in the last 20 years, what percentage of gain would you need to get back to 100%? The answer is 50, right? How many people said 50? Yeah, you're wrong. It takes 100% gain after a 50% loss to get back to even. And that's not easy to do, which is why it's so important to have, to protect what you actually have. Now, maybe this is the reason, one of the most successful investors ever, Warren Buffett, famously said this about investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. So here are 3 strategies to protect against losses. First, look at every option to consider to reduce the risk. Second, consider how best to diversify your portfolio. And third, utilize financial vehicles, that for the right ones for your financial situation. And remember, don't procrastinate. Consider inflation and talk with your financial professional about ways to reduce or remove the impact of losses from your strategy. So, and last, we're going to talk about the impact of taxes. This is the 800-pound gorilla on wealth building threats. Nobody likes paying for taxes, especially when you're preparing for retirement. The tax strategy you put in place today can determine how much money you keep, how much you pay the government, and ultimately how much you leave for your kids. Understanding how financial vehicles are taxed differently can help you make a strategic decisions that pay off big time down the road. Now, when you sit down with them, you talk to a financial professional, they can help you look at which of these types of taxable accounts that you're in or type of account you're in. But let's just keep it real simple for you right now, okay? You have the colors of these icons matter. The red icons are taxed now, and the yellow is going to be taxed later. You see those? So taxable accounts, and this is the only places where your money can really sit in these type of accounts. Taxable accounts is includes investments made from business income or employment, salary, wages that have already been taxed. Taxes are paid annually on interest, dividends, earnings earned unless held in qualified retirement plans. Qualified retirement plans, that used to be my specialty for a number of years, particularly the 457, but 401k, 403b, 457, and IRA plans allow you to invest pre-tax dollars with no taxes to pay on the principal or growth until retirement, at which time you'll pay income tax at the future tax rate on the full amount of distributions each year. Annuities, except for qualified plans, money invested in annuities will already have been taxed. Growth is tax deferred until retirement. At that time, you pay income taxes on the growth portion of your distributions each year. Now, let's look at some green icons. Green is the color of money and growth. It's also the color of our tax never. And their different accounts can be taxed completely differently. So green means no tax at all. Green never looks so good. First one is government bonds. You can use after-tax money to invest in government and municipal bonds, excluding qualified retirement plans. And depending on whether the bond is federal or municipal, interest may be exempt from federal or state taxes. Roth IRAs. You invest in a Roth IRA with after-tax dollars, your account grows tax-free, and you don't pay taxes on distributions in retirement. Permanent life insurance. Premiums are paid with after-tax dollars. As long as your policy remains active, you will never pay taxes on distributions you take for supplemental retirement income on special purchases. That's why it's called, another name you can Google is the rich man's Roth. They're talking about this right here, this permanent life insurance. It's where a lot of people keep their money, a lot of banks, a lot of corporations, and a lot of the reason is the tax treatment. Now, if you save $10,000 at age 29, earn 9% annual interest each year, you would have $250,000 when you reach 65. Now, think like the farmer for the second, real quick. Would you rather pay taxes on the seed or the harvest? The answer is going to be, of course, whichever is smaller. We all don't want to pay more taxes. We want to pay less. So a farmer would rather pay taxes on the seed, not the harvest. An investor would rather pay taxes on the money before it grows, not after. So you either pay taxes now, later, or never. Now, which one will apply to you? It depends on the vehicle that you choose. And again, this is where a financial professional can really help you fine tune which one's going to be appropriate. Now, in a recent Gallup survey, 85% of non-retired American investors strongly agreed that having a guaranteed income stream in retirement to supplement Social Security benefits is critical. Guaranteed income can help you avoid the risk of running out of money in retirement. And there are 3 components of reliable retirement income that we recommend that you consider all of them. Maintain potential for growth potential by participating in the upside growth of the market. Reduce or remove potential for losses by eliminating downside risks tied to the market. And 3, create a predictable income that lasts and protects and prevent the possibility of running out of income in retirement. So you want to have something that's going to go no matter how long you live. And there are ways that you can do this. Finally, the last milestone we're going to wrap up here is protecting wealth by creating a will, guarding your legacy. This is something that even the rich miss. But I like to start here with clients because it's the easiest thing to do. And, you know, it just takes a decision. You know, that's all it takes to do some basic things like that. But, you know, you look at people like Prince and Aretha Franklin who had pretty sizable estates, but neither of them had any kind of estate plan. They've left all their business partners, their family members in a legal and financial mess. It's taken years to sort out. It shows you how important that having your estate plan together is. 64% of Americans simply don't have a will, any kind of estate plan, but it's not surprising. It's higher for younger Americans and than it is for older Americans. But Prince was only 57. You know, he didn't expect to die. There are 4 documents that your estate plan should include. It includes your will, your financial power of attorney, your living healthcare directive, or living will, advanced healthcare directive, and your HIPAA release. Those are some real simple things. Like I said, it's just a decision. You know, you get these, you print them off, and then you sign them in front of a notary, and you're done. You got it. Put it in an envelope. Make sure somebody knows where it is. The last thing you might want to do is estate planning is not too expensive. You know, you can also add in a trust and things like that. There's a lot of great options out there and for any budget, you know. But this is the one. This is one you can check off immediately if you haven't done so. So it could be just a few $100s. You can have all that squared away. Now, each milestone that we went through is critical. Is a critical step, and if you to reach your financial stomach. Because of this time we spent together, you're increasing your financial literacy concept by concept, strategy by strategy, learning to take control of your personal finances, which will give you the confidence to discuss your situation with a financial professional, which we strongly recommend. Now, this is the time where you can put everything you learned into action with your financial professional who can assist you to crunch the numbers, chart your path, choose the products, stay accountable, course correct along the way. Don't try this alone. Let me say this again. Like I said in milestone number 1, if you're actively working with a financial professional whom you know, like, and trust, and that person is doing a good job for you, then by all means, keep doing that. You know, I go far as to say to cherish that relationship because it's all too rare. But if you're working with someone or if that person is falling down in one of these areas, if you don't know, like, or trust them, or if they're just not doing a good job for you, you know, I'd love to have a discussion about our process and what it might look like for us to work together. So here's what working together might look like. We don't have a one-size-fits-all solution. We know that everyone's different and they're in a different place in their life, but it works like driving directions on a mobile phone. 2 points of reference is all you need. Where you are now and where you want to go. And the same is true to chart the course for your financial roadmap. So we break this down to 2 parts. The first part is called a discovery call. This is a quick, non-threatening telephone call where we spend 15 to 20 minutes discussing things like your family, your career, you know, what you're currently doing from a savings and insurance standpoint. And most importantly, what are your goals? You know, we're free agents, so we go into the marketplace to find the companies, products, and services that are a best fit to take you from where you are now to where you want to go. Then we schedule a solutions appointment, which is typically 30 to 45 minutes, where we make a few specific recommendations on how we think to best implement the 7 money milestones. The best way to prepare for your discovery call is to read the book, How Money Works, Stop Being a Sucker. If you don't have a copy, contact me. I'll be happy to get you a copy. In fact, this step of reading the book is so important that we asked one of our characters from the book, Clark, to make a video about it. So here's Clark now.
To read the book. The future hangs in the balance. Read the book. See, this is why you need to know how money works, so you don't buy cheap stuff off the internet.
So now we're going to hand out there's an evaluation form that I have that I love your feedback. When you get it back in, we give you a free copy of the book. Tell me what concepts resonated most with you. And if you'd like to get together, review your personal situation. If you know any schools or companies that would benefit from, our coming to teach the class, let me know. I love to hear about all that stuff. So then read the book. So we look forward to seeing you next time. I appreciate you guys. We'll open it up for some questions and appreciate your time.
Great job, Kenan. Appreciate you coming out to talk to us a little bit, man. I thought this was important. Can you guys hear me?
Yes.
Okay. So yeah, I thought this was important, man. I know we all are entrepreneurs and we all trying to get it, right? Unfortunately, man, things happen to us sometime, right? So let's say we the breadwinners of our family, and if we're not taking care of the things we need to take care of up front, our family can suffer on the back end. You know what I'm saying? So like you just talked about Aretha Franklin, right? Prince. They had a lot of money. But look, right now, to this day, their families are trying to get the money because they didn't do the things they need to take care of up front. You know what I'm saying? So if this is something you guys can benefit from, of course, and of course, you know me, I'll keep it real. I don't get a kickback or anything like that, right? So this is not what this is about. But I've been to one of this class and I thought this would be very beneficial for everybody. And so you guys got questions, please ask as many questions as possible. You have any questions for him?
No, I just have a comment. I do think that it's important. I think a lot of this stuff that you talked about, when we're in our 9 to 5s, a portion of it is taken care of, like retirement, putting your money to the side and things like that. And as an entrepreneur, I just think it's important because we don't have that structure already put in place.
Absolutely.
So, yeah.
Absolutely. I agree 100%. Entrepreneurs get really wrapped up in their businesses and running a business. Being an entrepreneur myself, I get it, but I just happen to be in the business about building wealth. So, I have to be on, I'm a practitioner of everything that I talk about. And I'm very passionate about that because it's made a difference, since I started applying those things. And, but yeah, running a business, being an entrepreneur, whether it be a lot of people today are solopreneurs, it's just them. And so there's really no exit strategy on the back end, but some people, they're building businesses that have an exit strategy. And so like a business owner might have a lot of their net worth tied up in a business, well, how do you liquidate that and turn it into a retirement stream? I mean, that's a whole nother conversation, There's different levels to this, but if you don't understand the basic levels, the basics that everybody should know, then it's going to be problematic to even address that down the road.
Right. One of the things I see, even people with money, right? The first thing that they get is a financial advisor. It's important. It's important to have one. Definitely important to have one.
Absolutely.
Question. Can everybody hear me?
Yes.
All right. So what
Yes.
are some of the top methods of getting those higher interest rates? Because I know you talked about life insurance policies and whatnot. Like what's your top 3 favorite high interest rate methods of investing your money?
Well, there's certainly the index universal life strategy gives you the ability. It's inside of a life insurance policy. It's a great option. Solid. You don't have to worry, especially for safe money. People who want some guarantees on their money. That's a great option. There are also various fixed index annuities. For example, they're going to allow you to create like a SEP IRA. One of them is a lot of self-employed people would start with the SEP IRA. You fund it with $10,000, and you can get access to that interest as well. And it is inside of annuity structure, so it's set aside specifically for retirement. And that's something I think that's even more important is that you got to have these different buckets of money. You can't have all your money in one thing ever, and if it's a bank account or whatever the case is, you just want to make sure you're getting a good interest rate. But fixed index annuities, we call it the reliable income strategy, and that can give you a guaranteed check for life. You remember the old days, maybe our parents and people that retired from the military, they have pensions that are going to pay a check for life. That's something about retirement you've got to get. You've got to get something that's going to give you a check for life. And that's the whole point of or how you're able to be financially independent. Think about it. It's the income. The bills never stop just because you stop working. The bills keep coming.
Yeah.
Now you said something about the Roth IRA,
Yes.
also the permanent life. And you said the government. What was that part? The other part?
Government bonds. Yeah.
Government bond. Tell me a little bit about the government bond.
Government bonds are tax exempt because they're issued by the government. They don't tax their own product, essentially. So municipal bonds are exempt from state and local taxes. Federal bonds are exempt from federal income taxes and sometimes municipal tax or local taxes. It depends. But it is a way to accumulate, So, you got to look at especially if interest rates go up, which if inflation keeps going and the Fed keeps rising the cost of money, then the bonds will become very attractive. But right now, you kind of have to be careful, with it. If you're going to do that, again, use a financial professional. If you're never invested in something, especially like that, you definitely want to use a financial professional. But Roth IRA is another tax-free vehicle. And Roth IRA is just a bucket. You got to put an actual vehicle inside of it. So you can have mutual funds inside of it. You can have an annuity inside of it. You can have whatever inside the Roth IRA. It just means that when you decide to take the money out, it's tax-free. And the other one, yeah. I'm sorry, go ahead.
Go ahead. Sorry, that was my question. I think we're all pretty much on the same page when you start talking about these different accounts that you can invest in and potentially get up to 15%. And that's one of my questions was, I'm in the process actually, and I have been looking to roll my IRA, my 401k from Fidelity into a Roth IRA. And I have been researching and I'm looking for the highest interest rate.
Mm-hmm.
You have any tips on what banks might potentially have the highest interest rates?
Well, run from a
life insurance company, not from a bank.
You're not going to get it from a bank. They're not going to. That's not where you want to go. You want to get someone who has access to different set of products and services than bank products. Bank products are not going to get you where you want to go. That's what I mean by a financial professional. You need one. If they have access to the products that we have, that we talk about, or even other products like mutual funds, brokerage accounts, managed accounts, things like that. depending on your risk tolerance. So that's what I would definitely recommend is to, and I'll be happy to if you don't have currently have one. I'd be happy just because I take a very educational process. There's never any commitment or anything where it's like I'm expecting you to do anything. It's like, look, you don't know about this. I'm going to share it with you. If you decide that you like it, I would appreciate you do the business with me. That's kind of how I do it.
Right.
So that's kind of how we do that. But yeah, it's a relationship business. This is not like you show up and then you disappear. No, it's like if we do business, we're gonna be 30 years later, we're gonna know each other. Now you're gonna have my phone number. That's the kind of business this is.
Get Christmas cards from mine.
Exactly.
So now you talked a little bit about emergency funds, right? I know everybody talks about 3 to 6 months. What's the science behind that? Why not more?
Well, you certainly can have more, but then you start getting into the stuff that it's in is going to have a lower interest rate generally if it's accessible. So that first 3 months, I think, should be very accessible in liquid, and so you're not too concerned about the interest rate with that money. You just needed to be there and be able to put your hands on it in emergency time frame.
And that's your household expenses, right?
Yeah, whatever it costs you to live the way you like to live, multiply that times 3 to 6. Yes.
Okay.
Mm-hmm. And you can do all of these goals at one time. It's not one is not mutually exclusive. So like you can have X amount of dollars going into the emergency fund account, X amount of dollars going into the retirement account, X amount going to paying off the debt, or whatever, and then the protection, But it's just that's how you build wealth. Is you got to have those little buckets where it's kind of almost hidden from your daily view on a regular basis. And you don't think about it, but it's automatic. That's one of the easiest ways to build wealth.
Okay.
And I want to piggyback real quick because I know a lot of people hear that they think that's intimidating, but if you simply just trim the fat on a lot of your expenses, cut out one of those fast food meals a day, maybe not buy as much new stuff and things like that. It can be real and attainable. And I just wanted to make sure people heard that because I know people will hear 3 to 6 months in a savings account. What? Like it's the little things count. And that's why it's important to know where your money's going. So you know where you're bleeding and you cut that bleed and move that bleed into a savings account. And then you can start making that money work for you.
One of the things these companies are doing is what they call the drip, right? So a little bit amount of money comes from your account every single month. You're not gonna really miss it. So like Netflix is really inexpensive, but you can forget you have it, and it can be dripping out of your account constantly for years. You know what I'm saying? So you get your checking account, print it out, and see what's coming out of your account, and adjust it accordingly. That'll save you some money right then and there. Matter of fact, I've got one now. I think that we even looked at it. Why need to change that?
Your account.
So. Well, okay, I got a good question there. So, are you familiar with the 10-20 rule?
Yeah, basically it just means it's about how much you should have in debt. Your consumer debt shouldn't really exceed 20% of your income, and it should be less than 10% of your cash flow payments out. So you want to keep it within a range. It's basically dealing with debt to income ratios and things like that. And that's something to keep in mind for sure. Yeah.
Okay.
Absolutely.
And I know a lot of the questions the stuff you went over is kind of a lot of the questions that I had, man, like the rule of 72. Can you kind of break that down a little bit? Little bold?
Yeah. The rule of 72 is super important to understand because it just really, when you start looking at your financial situation, you're like, man, I'm paying 10% on this, debt right here, or I'm only getting 1% over here. I can't allow that to happen. So the rule of 72 gives you a mental math shortcut to just easily assess anywhere you have money that's affected by an interest rate. And you just simply divide 72 into the interest rate. And there you go. It tells you, so 72 divided by 1, it means it's going to take 72 years for your money to double. And it's a useful tool to understand. Business owners need to understand it. I have a guy I work with. He's an entrepreneur in the pallet industry, and he does factoring on his not he does factoring, and so he learned these concepts. I taught him these concepts, and he has created his own family bank. It's allowed him to basically finance these loads of, because a lot of these companies pay net 30 or net 60 with the pallets. So he'll get the purchase order, he'll send the money, he'll put the money out. But what he learned was like how he could get, because he understands how money works, he can do the 90-day or the 60-day, and he charges more accordingly. If they're going to pay 60 days, he's charging them more. So it's just, it's very applicable to a lot of different things when it comes down to that.
That's powerful, man. This is something that we, when I was younger, man, I say up to probably about 5-6 years ago, I didn't even know about the rule of 72, right?
Yeah.
And I think that's our issue a lot of times, man. It's some stuff that we don't even know how money works, man. You know what I'm saying? We go get these high interest rates because maybe we won't take the time to get our credit together or whatever the case is, and then we get this high interest rate, and then you've been paid twice or 3 times the amount the car's worth. Last 2 payments they come and take it. You know what I'm saying? Because you can't really afford it or whatever the case is, man. Listen, man, we have to understand what this means. The rule of 72 is very powerful. Understand it, man. Understand it. He made a whole business off of knowing the rule of 72. Other people don't even know. He made a business off of it. So hey.
Yep.
Powerful, man.
Knowing how money works is a critical life skill, in particular for entrepreneurs. And another thing that's important that a lot of people do is that all their money's in risk assets. It's all like they go to the things that move money, but a risk asset like stocks or Bitcoin or whatever, like Bitcoin's down like 50%. If you bought it last year, and then you were banking on that, well, and you had an emergency and you thought you had 50,000, now you got 25. It's not a great place for emergency fund. And so a lot of people skip over those basic principles. They're not as sexy as like the Bitcoins and the whatever, but they're important. You can't you can't make sense of everything else without having that foundation, and you'll make the wrong moves.
And like you said, don't put all your money. Like if you want to, after you got the emergency fund and all that other stuff, then go play around with it. If you make more money, now move it to a more secure place.
Yeah,
I think that's it though. I think that we're having so much conversation about investing, stocks, Bitcoin, all of these things, and people are jumping over, some very tangible foundational things that we need to be thinking about and going to these long-term choices when those long-term choices are truly for the mindset of a patient person or a more stable person. But I go back and say, as an entrepreneur, because you don't have the structure of a business that has already thought about your insurance, your death benefit, your IRA, those things, it's just imperative that, you take time to figure that out and take time to figure it out. I think, again, we're always rushed to do things. I think there's this sense of urgency. And I don't know, I'm not saying that you're saying that, sir, but I'm saying sometimes we have this sense of urgency, like, oh, I need to figure out how to do this thing. And I always tell my clients, we overestimate what we can do in 1 year and we underestimate what we can accomplish in 3 years, and I learned that from my coach. And so just have a strategic plan in place, like by, this year, by 6 months, this is where I want to be. And then give yourself time to, roll out your plan, right? Because you don't have to do everything at once, And I think that that's what stopped us. Like you said, I think you said there's a lot of anxious. I wrote this down. There's a lot of anxiety related to debt. Well, there's a lot of anxiety just related to money, and how we use our money. And if I'm saving my money, or if I, in that anxiety, you also said another quote, procrastination is hands down our favorite form of self-sabotage. And I feel like we procrastinate. And a lot of times it's just the anxiety of not knowing what to do, because we don't have a plan in place to say, I'm gonna give myself, 6 months to save my reserve. I'm gonna give myself, however much time you need, but doing a little something, every month, every week, and having the conversations just for the awareness. And I think our intelligence is so powerful that once we become aware of a thing and then understand a thing, then we can, discreetly go into it with a little bit of angst, but with the knowledge of this is direction I need to be going. But a lot of times we just put up a wall because we don't know, and so I thank you for coming on and going through that process for individuals. And it is just the basic foundational principles. I think about econ class. I know we don't talk about financial literacy in class, but in schools, but I think everybody had an economics. Nobody had an economics. So we had like econ 1.
I went to school in the hood.
We didn't pay attention to it though. A lot of the concepts in your econ, who went to econ class? A lot of us skipped in, if you went to Saginaw High, we was down at, Mrs. Willie's stand or something. And so we just didn't get those concepts, nor did we understand, sometimes language when we talk about money is just so like foreign, you know what I mean? Investments, the rule of 10-20, the 72, it's like, okay, I'm lost. I stopped listening to you, and now I'm in my mind talking, and you sound like want,
And Sheila, I think that's a good example, because even in high school, like for me personally, I wouldn't have been able to go back to talk to anybody about this stuff if somebody would. We could talk about science and math. So you go back talking about money, you go home talking about your mama about her money. How is that going to go over? So it's also about, how we always go back to, that mindset of being comfortable just talking about it. And once you learn about it, okay, engage in a conversation with somebody, challenge them like, hey, you got a budget? I need a better budget tool. You know what I'm saying? So.
And, I think that when we make $100, we feel like that whole $100 is ours,
Right.
But in business, if you work for a corporation, that whole $100 ain't yours. Like they have, your, what is it, your gross and your net, right? So you may have netted this, but we only go give you this. You know what I mean? And we're okay with that when we work for somebody else. But we're not disciplined to say, okay, this is my net, and then this is what I gross, right? Like we don't do that mechanism, or even bring anybody in. Like, I know this whole $100 ain't my $100. You know what I mean? So help me to, 70-20, 70-30, or okay, how much? Let me take $30 and do something with it, and keep my $70 for myself. Well, let me take $60 and do something with it. Like, we don't have that thinking, like, no, that's not all of your money. You know what I mean? There's things that need to be done with at least 40% of that money, that's going to benefit you, tax wise, retirement wise, and your kids and all of that, and and it's these foundational things that need to be put in place.
And money talks to money, and so here's another problem. Once what you were talking about, you brought up another issue, is like, it's not in our community. One of the reasons why is there's not a lot of financial professionals in our community. I've been going to these conferences for 20 years, and there's usually like 5 people that look like us in the room of thousands. So if this is a warm market business traditionally, meaning if you don't have a relationship with someone, because it's a 30-year thing, right? If you don't have a relationship with someone, you're not going to get this information. You're not going to get access to these products and services and strategies. That's the reason. It's because it is a relationship business, and the money has been talking to the money for the hundreds of years. They've been talking to each other, and it's finally trickled down, and we got a few of us in here.
Listen, and I'm gonna say this. The insurance guy that came and knocked on our door was like the Jehovah's Witness that came and knocked on. Oh, that's the insurance.
That's the only kind that we get. That's the kind. It's been that way for a long time in our community. It goes back. One of my associates down in Florida, he actually did that, and I was like, "What? I would never." But anyway, I came into
back in the day. That's what they did. So I'm saying our culture learned at very young age. When the insurance guy came and knocked on our door, it was literally like the Jehovah's Witness coming and knocking on your door. Like, that's the insurance guy. He want to talk about insurance. He just want to get our money. We don't need no insurance, And then we grow up with these limiting beliefs about the opportunity or the investment of insurance, because we were taught when he came to the door, everybody be quiet, don't say nothing, so he can go. We come up of age and we see the insurance guy or the bank guy, and it's like, oh no, we don't talk to him. Like he's not good for us. And so it's really about shifting the mindset. Like, no, that's not what that is. It is about your investment and how you're investing your money in your personal relationship with your money.
Yep.
Exactly. You think about how much generational wealth has been built off of life insurance. Man. So if we had that education back then, all these, think about all these people getting killed nowadays, right? Especially when we was coming up. And we had GoFundMes back then. We had cook some tacos or whatever, because to bury these people. So imagine if all those people got checks and they could invest that money back into the community. You know what I'm saying? Or whatever, man. So we had to kind of tweak it a little bit, man, to adjust our mindset. Like you said, man, you go to some of these conferences and you see only 2 or 3 of us, and that's disappointing to me, man. I'm like, where we at, man? Where we at? And we need it more than anybody. You know what I'm saying? So that's why I want to make sure we bring something to the table. It's financial literacy. What does that mean? We got to become literate when it comes to financial situations or issues or whatever the case. Across the board. And hopefully somebody who's watching this or who's going to watch it down the line hears some of this information that helps them. Like he just talked about Aretha Franklin didn't have a will. Like, I don't have a will. I don't have one. Why not? You know what I'm saying? Why I don't have one? And that don't make sense, man.
That goes back to a point I want to make, because without the education, the money don't make a difference.
It's true.
If I die today and my kids and my family get $500,000, but they don't know what to do with it, what have I done? What have I truly done? Yeah. If I, like you said, even if I got a will and I say do this, this, and this, and then they have a chunk, but if they don't know what to do with that chunk, it goes back to the education. Anybody can have money. I think we talked about that a couple weeks ago, where it's like, you got millionaires who their kids are blowing all the money and they're not continuing the generational piece. So the generational piece is founded in education portion. You can just give kids money. They need to understand what to do with the money. Same with your spouse, your family, everybody.
But what if you make you make you $10 million, right? And something happened to you, and your money is tied up in this system because you didn't do a will. Now half of your money, if not 60-70%, is going towards lawyer fees and all these other things, and hopefully your kids get it. That'd be wrong, maybe financially wrong.
Yeah, I think we're talking about
the lawyers gonna get their money.
We might be, but that was on my mind. So
I'm just saying, I think
that real. I was like, damn.
And not looking at, I think one of the powerful things he talked about, though, and a couple of other insurance people came on, and not looking at an insurance policy as a life benefit, right? Like, looking at it in a more comprehensive umbrella of, oh no, I'm investing in my own bank, right? That I can pull out of, that I can do this, you know. And I think we've just attached insurance policies to death, you know, and it's so many other, you know, things that you can offer from that. But when we start talking about death in our community, I mean, that's even a,
which blows my mind, because I will say it all the time, and this what drives me crazy when people are opposed to life insurance. That's the only thing we know for a fact will happen other than taxes. In this country is we're going to die. Like, I don't know why people,
easiest way to create generational wealth.
Easiest way.
Like,
Easiest way.
but
Policy
you know
on your
gonna
kid as soon as he's born. Get a real one. Get $250,000 or $1 million. Don't get the $10,000 Gerber. Nothing wrong with that.
No.
But if you want to create generational wealth, you got to go in hard. That's what I did with my son. I got 2 policies on him, real policies. You know, from the time he was born.
I like that.
You know? Yeah.
And the thing about doing it at that age is that it's less expensive. You lock in the rate, you know, versus trying to get it at, you know, my age, 43, or, you know, older, or 30, you know. And I mean,
or after you develop some kind of illness, and then that cuts you off of qualifications for so many of the really strong beneficial policies. You might be able to get a little struggle policy, but get it while you're young.
Absolutely.
Or get it now.
And also, like we've heard on one of the calls, that a lot of we're not educated, so we think that when we're in corporate and we have their insurance policy, it's the one all be all, and it's not, because if they let you go, that's the end of that policy. You know, that policy does not go with you. You know, and so oftentimes
a weak policy.
Say, well, I have insurance through my job, and that's just temporary.
That was major. That was mind blowing when I heard that. I thought it was at least 30 days. You said no, it's over. Once you out of there, you out of there.
Done.
Wow.
Absolutely.
So
and I want to say to our viewers, because I mean, this is a foundational, you know, conversation about, you know, financial literacy. I do hope that individuals stayed on. You know, I stayed on. I wrote my notes because, you know, and teach it to somebody, because, you know, what you teach, you actually learn a second time. So tell somebody, have a conversation about a conversation about some of the things that you learned today, because that's going to keep your mind thinking about it and even analyzing it a little more and making it more personal to you. So if there's, you know, out of those, what was it, 9 steps, you know, teach somebody 1 or 2 of them.
The 7 money milestones.
7 money milestones. You know, teach somebody at least 1 or 2 of those that came up for you, because again, what you teach, you learn twice. You know,
exactly. Yep.
Absolutely. Yeah, get a copy of this book. It's on Amazon.
Great. I'm like, oh yeah, I'm taking my stuff, my daughter,
it's going down.
Absolutely. Well, let me know if you want a copy of the book. Just go to my web. The easiest way, you can either go to in the chat. If you want a copy of the book, I'll be happy to send it to you. And it's free. So, and I don't, you know, only thing I say, I mean, since you guys are all on here, I feel like I've met you. I will send it to you as just part of the deal. So get the book, you know, just send the address on that form, or you can go on my familyofficebuilder.com and put your information on there if you would like it, and I'll ship it out to you. And that way you'll have it. And then if you know anyone, we are looking for How Money Works educators. So like you were saying, Sheila, the best way to learn it is to teach it. You want a side business teaching financial literacy, then let me know. Let's talk, because we are looking. I can't do this all by myself. You know, the people I work with from a client basis, you know, there's only so many I can have personally to do a good job. And so we need more people. We need literally about, I want to touch personally through my efforts and the results that I'm doing. I want to reach at least 100,000 people, you know, and help them with financial literacy through the efforts of organizing other people who like this information and want to share it, and then they can make a nice little profitable enterprise for themselves as well if that's what they want to do.
I just want to close with two things because I don't teach financial literacy, but as a coach, what I've learned is that the number one story that's holding you back in your life is not your love story. It's not your, trauma from a child. It is your money story. And your money story is so aligned with the factors that's happening into your life. It be in your relationship, which is why marriage is, one of the number one reasons marriages break up is because of money. If it's with your family, if it's with yourself, the anxiety that you hold, the reason why you work hard, the reason why you play hard, the reason why you got a whole closet full of clothes and not wearing them, the reason why you broke at the end of all of it, the number one story that frames our life or shapes our life is our money story. The second thing I want to say is, as entrepreneurs, sometimes we put the cart before the horse. And what I mean is that when we go get a job, we have to understand that people have already put this thing in place for you when they hired you. So they give you a packet and say, this is how much you have. This is what's going. This is how much this is going to be. And as an entrepreneur, we have a due diligence in our business to set this package up. So when we start making the money, then we know where we're allocating these funds to, And I think that that's just so important that we stop putting the cart before the horse and really start structuring our businesses, whether it's an LLC, whether it's what's the one where it's just your name, whatever, sole proprietorship, whether it's an S Corp, whether it's a C Corp, whether it's on a Schedule E and it's just, rental properties, let's really start working on our money story. And I am guilty of putting the cart before the horse. And I feel like I'm playing catch up because it's like, oh, now I get all this money and I don't, it's just, and I had to go back into my money story and say, hey, Sheila, you got all this income coming in. Why isn't there more foundational things in your life? Why isn't there more, stabilization in your income? And it's truly because every venture I went into, I always put I did hair, I made money, and I was a hustler, as a therapist, I made money. And I never just sat down and really looked at structuring myself as a contracted employee, as a hairstylist, and then started my own business in a way that really, at the end of the day, created a win-win situation. My clients are benefiting and I'm benefiting too.
Yeah. Well, I have one more question to touch on about compound interest. Tell us a little bit more about that.
Compound interest is just that thing that's just running you could think of it like an engine, where you make money while you sleep. It's interest earning interest. There was a story of John D. Rockefeller when he really understood the power of it, where he loaned out $100 to a guy, and the guy paid him back the loan, and he made more money from the money that he loaned than the labor that he did in 2 weeks. So he said, I'm going to get as much money to work for me as possible. And so that's compound interest. If he takes that money and reinvests it, so now he has more money to loan out or to in an investment or wherever it is. But basically, if you look at each dollar as an employee, you put it to work and it generates a profit. You take that profit, that's a new employee, you put that to work, it generates a profit and so forth. So compounding interest, it just gets bigger and bigger over time. And it's, it really is just an amazing thing when you think about it. It does require patience because you don't see the real results of compound interest until, down at the other end of the curve. It's like a bamboo tree. You plant it in the ground, you won't see anything about the for years. The bamboo will just be growing the root structure, and then all of a sudden this in just a short period of time, that bamboo shoots through the ground all the way up top. That's kind of like compound interest. You got to wait for that shoot to get through the ground, and then it just takes off at the later end. So that's compound interest.
No. Man, this has been very educational. You guys have any more questions for us, Ken? Man, I think you floored us, man. Great job again, man.
Yep.
Definitely don't be a stranger. Come on anytime. We're going to drop that knowledge like that, man.
Oh, yeah. I appreciate you having me, Jay. I'm glad you moved the time, because the time you had before was not an ideal time for me to be able to do it. So this was able to work out. So I appreciate that. And I knew we were going to work it out at some point to get together. So
yeah, absolutely.
Great.
Absolutely. Yes, well, thanks again, man. And hopefully, some people reach out to you. I will make sure I'll post your link a couple more times, man. So people that listening on, man, can get that book from you.
Okay.
And anything I can do to help, man, definitely reach out to me. You know me, man.
Yeah, most definitely. Yeah. Well, we're trying to share a lot of books and get this education. If you think there have any organizations or even your family group, I'm happy to do a presentation for anybody. A lot of times, I had a family reach out to me. They're going to get everybody together over a Christmas holiday or whatever. We get the books to them, and we do the class and all that. So it's definitely something that I can do for anybody. So
okay. Sounds good.
All right.
Any more questions, guys?
No.
Appreciate it, man. I know it's a little different from what the norm is, man. But I think it was very educational, man. I think we all can benefit from it.
Yeah.
And so again, guys, if anything I can do to help, man, definitely reach out to me. And look forward to seeing you guys next week.
Okay.
All right. Peace.
Bye.
Have a good one now.
Bye.
Bye-bye.